The trade balance, which is the difference between the value of a country's exports and imports, has a significant impact on the economy and can influence the value of a country's currency. Trade balance can be categorized into two types: trade surplus, which occurs when a country exports more than it imports, and trade deficit, which happens when a country imports more than it exports. Let's explore the impacts of these two types on the economy, exchange rates, and investment. Trade surplus. The trade surplus occurs when a country exports more goods and services than it imports, resulting in a positive trade balance. Here are the key points related to trade surplus. 1. Economic growth. A trade surplus can contribute to economic growth by increasing domestic production, employment, and investment. When a country exports more than it imports, it generates revenue from foreign markets, stimulating its economy. 2. Current account balance. A trade surplus improves the current account balance, which includes trade in goods and services, investment income, and transfers. It indicates that the country is earning more from exports than it is spending on imports. 3. Exchange rates. A country with a trade surplus may experience an increase in the demand for its currency, leading to appreciation. The higher demand for the currency strengthens its value, making imports relatively cheaper and exports more competitive. 4. Impact on investor confidence. A trade surplus can positively influence investor confidence, as it reflects the country's competitiveness and economic strength. Trade deficit. A trade deficit occurs when a country imports more goods and services than it exports, resulting in a negative trade balance. Here are the key points related to trade deficit. 1. Economic impact. A trade deficit can have a negative impact on economic growth by potentially reducing domestic production, employment, and investment. It means that the country is spending more on imports than it is earning from exports. 2. Current account balance. A trade deficit leads to a deterioration of the current account balance, as the country is paying more for imports than it is earning from exports. 3. Exchange rates. A trade deficit can result in a depreciation of the country's currency, making imports more expensive and exports relatively cheaper. 4. Impact on investor confidence. Persistent trade deficits may raise concerns about a country's competitiveness and economic growth, potentially affecting investor confidence and market sentiment. In conclusion, while the trade balance is just one of many factors that influence currency value and overall economic health, it holds a significant role in shaping a country's economic landscape. A positive trade balance, represented by a trade surplus, can lead to economic growth, improved current account, and potential currency appreciation. This surplus can stimulate domestic production, create employment opportunities, and attract foreign investment, fostering a robust economy. On the other hand, persistent trade deficits, where imports exceed exports, may raise concerns about the country's competitiveness, domestic industries, and employment levels. It can result in economic challenges, potentially reducing domestic production and negatively impacting overall economic performance. While the trade balance remains a crucial consideration, it is essential to recognize the interconnectedness of various economic factors such as interest rates, inflation, political stability, and market speculation.